And here come our participants. Well, it's refreshing that people are just waiting for him to turn it on. Good morning, everybody. We're going to take a moment because it's taken a while to let everybody in. We have registered over 400 people for today's webinar. And we thank all of you for joining us today and ask that you bear with us while we give others just a moment to log on so that they can get the benefit of the entire time here. And just a reminder, everybody that is now logged into it, would you please, if you have any questions, put them in the question and answer box. That's the only place we'll be looking for questions from you. And I'm going to take a moment now and several times today, wish to thank Robert Hall and Associates for putting this all together. We really appreciate them. They are a sponsor to my group, Los Angeles Real Estate Investors Association, for many years now. And do all taxes for everybody. And a good job of it. So let me get started. Good day and welcome to the 2023 version of the Los Angeles Real Estate Summit. I'm Bill Tan. I'm fortunate to be your host. And we thank our hosts. I'm the moderator. Our hosts are Robert Hall and Associates over there in Glendale. This has been an annual event. I'm not sure, but I think, is this number 7? Number 7 or 8? And every year they've provided excellent information. And that's all it is excellent information, no sales. So we're going to do that again this year. We hope that in the near future, we can get back to doing this live and in person, where we get to meet everybody and all the vendors. So we have with us today for this panel, several distinguished members. Let me start off with Daniel Arias. Daniel is from We Fund LA and New American Funding and has been a mortgage advisor for nearly 20 years and specializes in mortgage solutions in both the residential and investment space. Daniel has been recognized as a leader in mortgage lending, and he and his team have funded over $1 billion in residential and investment loans during his career. Daniel also serves on the board of the Pasadena Fire Foundation and is an aviation enthusiast and flies his fixed wing Piper Dakota plane out of the San Gabriel Valley Airport, which I think is Zelmani. It's also known as Zelmani Airport.
That's correct. Good morning.
We also have Bill Gross. Bill Gross is an expert on Los Angeles probate, not just Los Angeles probate, the whole state, because it's the same rules. He hosts a weekly call to discuss how to get sales in probate, how to engage with probate attorneys, and more probate-related topics for real estate agents and investors. The podcast is excellent, and I'm a fan. Born in Santa Monica, Bill was raised in Orange County, lived in the Inland Empire, San Gabriel Valley, South Bay, and for the last 20 years, in the west side of Los Angeles. He's been in real estate for over 30 years, closed thousands of transactions, and gives his all to help his customers achieve their goals. Next, we have Joshua Driskell, and I'm going to need help with that one. To his slide, please. Right? There we go. Thank you. As managing partner of the firm of, is it Lagerlof? Joshua, I didn't ask you.
Yep, that's right.
Thank you. Lagerlof. Josh brings a background representing businesses and individuals and a keen attention to detail to leading the firm. Josh's practice focuses on business, tax, estate, fiduciary, and related matters. He's a member of the Pasadena Bar Association, the Los Angeles County Bar Association, and the California Bar. Prior to forming Plymouth, Driskell, and Terzian LLP with partner Jonathan, and I hope I'm not killing his name, by the way. Is it Plymouth or Primuth? In 2014. Mr. Driskell worked at a multi-state law firm handling a wide variety of matters for individuals and small and medium-sized businesses. And lastly, but definitely not leastly, we have the esteemed Tony Watson. To all you in Southern California here, he is the voice of real estate tax education. He goes around speaking maybe hundreds of times during the year and does an excellent job at it. Tony is an enrolled agent that personally manages clients with over $350 million in real estate holdings. He has spoken for hundreds of trade organizations throughout the state of California. Holding a federal license as an enrolled agent tax practitioner, Tony can advise, represent, and prepare tax returns for individuals, partnerships, corporations, and any other entity with tax reporting requirements. Aside from his full-time position at Robert Hall & Associates, Tony is an active real estate investor, entrepreneur, and enjoys short and long-term trading. With over a decade and a half of experience, Tony, along with his team at Robert Hall & Associates, actively look for the newest and most up-to-date strategies to implement on client filings. They all operate with the same goal in mind, to help taxpayers keep more of their wealth and not overspend with the federal and tax revenue agencies. And may I add personally from my own perspective, and I've known Tony for quite a while now, he explains tax issues better than anybody I have ever heard. He relates it in a way that we can understand it, which is so nice. So thank you for that, Tony. Now this is going to, I'm going to go around and ask our panelists questions, and you may have questions. Remember, put your questions in the question and answer box. If they're personal questions, I would ask that you contact our panelists individually so that you can get the individual help you really require. And we're going to deal more on an overall covering of issues here. So let me start with Daniel, and you're the lender in our group here. So from your lending perspective, what are you seeing as it relates to the lending industry right now for buyers and sellers in the market today?
Yeah, first off, I'm really glad to be amongst such a distinguished panel of industry experts who bring so much value in their respective fields. And I want to thank Tony, Mike, and the entire RHA family for hosting us today. Kind of before we dive into it, clearly, I think we're in a very challenging market, one of the most challenging markets we've seen in a while. However, I think it's important to keep things in perspective. I heard Greg Geiser, who's the founder and CEO of Wedgwood in Manhattan Beach, arguably one of the smartest guys in real estate. He's flipped over 50,000 homes in his career. I heard him say that don't get too excited when things are good because it means they're about to get bad, but also don't get too down when the times are bad because it means they're about to get good. So I think today, our job is to try to help you find the opportunity in today's market and prepare for the good times ahead. So as far as it relates to financing with buyers and sellers today, I've often described this as kind of a period of reconciliation where I think buyers and sellers are coming to reasonable terms. And we're seeing some sellers that are trying to still set the highest comp in their neighborhood. And we see buyers who think that they have more leverage than they really do. Sellers want yesterday's prices, buyers want tomorrow's prices. And we've seen some escrows, fall apart and some deals cancel for some silly reasons. Seller wouldn't concede $1,000 to a buyer in lieu of a request for repairs. But we're seeing finally the parties kind of come together. We're seeing more realistic expectations being set. But this did take kind of 3 months of hemming and hawing, 3 to 6 months of back and forth. but I think, we're finally getting to a new normal where, it's stabilizing. I think the other challenge we're facing and dealing with is really the lack of inventory. I've often used the word and the term landlocked to kind of describe one of the reasons behind today's low inventory levels. Over the past year, we've had many calls from clients who want to explore a potential move for a variety of important reasons, a growing family, a work relocation. And although they might own a home with a considerable amount of equity, the thought of their property taxes or their interest rate doubling or tripling really leaves them in a position where they might have to stick it out. And those who are needing more space due to a growing family, they're tapping home equity lines to pull cash out and add square footage to their existing home. We actually just spoke to a family earlier this week who bought a beautiful 2-bedroom, 2-bath in Highland Park about 5 or 6 years ago for $750,000, but they need more space. They're on their 3rd child. Of course, we refinanced them in 2021 and they're in a 2.75 30-year fixed, but they need more space. And so they wanted to explore a possible move. And although their property value has essentially doubled and they can probably sell that house for about 1.5 million today, they'd have to go spend 1.7, 1.8, 1.9 to see any sort of meaningful upgrade in their living situation. And even though they can roll over $700,000 or $800,000 of equity into their new purchase, their housing expense goes from $3,500 a month to almost $9,500 a month. And so just because most people's property values have doubled, most people's income hasn't doubled in that same period. So it's leaving a move sort of inequitable for most folks. And so that's one less listing that hits the market. And obviously you don't need a PhD in economics to understand supply and demand. I believe we're going to see continued upward pressure on home prices.
Now, isn't it true that pending sales are down because of the increase in interest rates causing the monthly expense to increase also?
Yeah, Bill Gross could probably shed a little bit more light on actual listing and inventory levels, but absolutely, I think they're at the lowest levels they've been in a very long time. We're seeing more people just hold back inventory, take a wait and see approach, tapping home equity lines to make whatever moves they need to make in their personal life to try to reorganize their living situation. But inventories are very, very low, which again I think leads to there's still enough demand out there that will lead to upward pressure on home prices is what I believe.
I thank you for that segue to Mr. Bill Gross. Bill, is now a good time to invest in real estate, and how should one get started?
Well, I would say it's always a good time to invest in real estate when it's a good time for you to invest in real estate. I think the mistake people make is jumping in when everybody is, and it's not appropriate for them. So real estate, like any other investment, you have to be prudent, be appropriate. But the best time is when everybody says it's a bad time. That's when there's deals. That's when deals fall out. As Daniel mentioned, escrows fall apart over $1,000, which is stupid. But now that seller is faced with having to go all the way back to the beginning of time to remarket the property, but an investor can come in with a cash offer or strong offer, can tie it up and maybe get a significant discount. So, I would say look at the numbers of that deal, and in the right areas and the right time. It's a great time. Maybe not in Phoenix, Arizona right now, where it's volatile. Maybe not in Austin, where the market ran up so red hot. There's adjustments going on. But here in Southern California, as a couple of people have already mentioned, the limited inventory is preventing a drop in prices that's significant. And so I think there's a great opportunity. There are great opportunities here, and there's great opportunities also investing out of state. But those are opportunities. You have to look at them, vet them, and be appropriate.
If they're here, I'm a real estate investor myself, and I also mortgage. But one of the things I like is when things are bad, that's good.
Right. Yeah.
Is it a good time right now to invest, like say locally here in Southern California?
Well, again, I think it depends on the particulars. I mean, I was talking yesterday to somebody who had a property that's maybe worth 625, but they've wasted so much time. They're now faced with foreclosure, and they're probably going to accept about $500,000 to get rid of the property. And for the right investor, that's a great opportunity to avoid foreclosure, take the property to market, and make at least a quick $75,000, $100,000 profit. Is it a good time to overpay? It's never a good time to overpay. Is it a good time to walk into the intricacies of LA city and county rent control if you don't know what you're doing? No, bad mistake. You need to know what you're doing. But I would say that there are more opportunities now than there were 2 years ago because there's a little less competition. I'll give you an interesting statistic Daniel asked a question about inventory. I track it every week. Sales are down in my MLS, the MLS.com or combined LA Westside MLS. The units of sales are down from a year ago about 30%. But when I ask universally, lenders and title reps or anybody who goes into real estate offices or real estate brokers who manage realtors, there's about half the real estate agents working than was a year ago. So there's more opportunity per person working than a year ago, even though there's less overall opportunities. And the same with investors. It's amazing how many people who were thinking about it got out of the business. But now for the professionals, there's maybe 30% less opportunities, but there's maybe half of the competition. So to answer your question, and I think it's true, whenever it's a bad time in the market, it's a good time to look as a real estate investor for good opportunities.
Thank you. Let me transition over to Tony. Now, if we do invest locally, if we do invest, hopefully the callers on this are considering investing. I highly recommend it for you. Should they get a rental property? Should they incorporate if they get a rental property?
That's a pretty commonly asked question. Not everyone will need an LLC right out the gate if it's their first rental purchase. One thing about the tax side of this part of the equation is that LLCs are best for protecting large depreciable assets, but they're not going to save you any tax. So if you've heard or read something in the past where incorporating would save you a certain amount of tax when you get ready to file for the following year, and that this is the only way that you can save tax, just understand that LLCs won't be saving you any tax. Now, for the property flippers, the rehabbers, the wholesalers, the advice is a little different. But if you're looking for long-term rental investments, the best thing to do is to obviously figure out creative ways to protect the asset, which would in this case be an LLC. It's not going to be right for everybody. You do want to further understand the financial obligations with the state of California, the financial obligations with your tax filers or tax preparers, and just figure out if one, the purchase or the value of the property is worth throwing into an LLC. Number one. Number two, you got to make sure that the lender's okay with you acquiring the property under the LLC, because when they loan you the money, they're either leveraging your personal credit score, your personal debt to income, and they're expecting you to hold title under your personal name on that. And if you just go and transfer the property title to an LLC, that could mean some serious issues on the lending side of the equation. So the best thing to do is sit down with a legal advisor or even a tax advisor and map out probably what's best for you in your specific scenario.
If they're a business, if it's a business like flipping, would that make better sense to be an LLC or a corporation?
Absolutely. So on the flipping side, the federal government says that if you're flipping consistently at least 3 to 4 plus properties per year, you are not just a regular kind of base short-term investor where, whatever your gains are, you're paying short-term capital gain. At 3 to 4 plus properties per year, the federal government not only wants to hit you with federal and state income tax, but they also want to hit you with self-employment tax. And at that point, an LLC taxed as an S corporation would help reduce self-employment tax by upwards of 60+%. So depending on the volume that you're dealing with on a year-to-year basis, an entity could potentially end up not only protecting your assets, but also saving you quite a bit in tax.
Staying with you there for a second, Tony. Say someone is, well, some people think they call themselves real estate professionals. What is a real estate professional, and would it make sense to be either incorporated or an LLC for tax purposes?
Sure. So the real estate professional election is one of the most audited elections on an individual tax return. Not everyone will be able to claim real estate professional status. And the code is very straightforward about this. There's certain requirements that you have to meet, certain hours worked within the industry, certain active participation claims in certain real estate investments. At the end of the day, under audit, the federal government's going to look at the 51 rule, though. And you're not going to read about this in the Internal Revenue Code, but literally 98% of agents will look at where does 51% or more of your income come from? Is it coming from real estate related activities? Is it coming from accounting services? Is it coming from online sales services? And if 51% or more of your income is generated outside of the real estate industry or outside of real estate related revenue streams, they're not going to allow that real estate professional claim. Now, if you're married filing joint and one spouse currently isn't working and you, let's say, are the one that's bringing in most of the income for the family, the other spouse in the relationship could potentially make that election if that 51% rule applies. A lot of clients ask me, do I need to be licensed in order to be a real estate professional? And it is not a requirement of you to be licensed to make that election. You just have to be actively participating and managing your own properties in order to make that election. I'm being very general with my assumptions and my explanation here. There's a little bit more detailed Q&A that goes into it, but it's really important for you not just to go into a tax software and start checking elections on your return. You have to understand why you're checking those specific boxes and make sure that you meet all of those set requirements.
And so somebody needs a tax professional to ask them the correct questions in order to get the right tax. Right.
Yeah, not only to answer those questions, but to figure out creative ways to maybe convert somebody in a household into that real estate professional status. There's a lot of clients who I have entering into retirement, over the past decade and a half of working in the tax industry, where as they enter into retirement, and they start collecting from their 401ks and their IRAs, all of that is unearned income. I know that you've earned it in past years and you're deferring the tax on it, but in retirement, a 1099-R or a distribution from a retirement plan, that is all unearned revenue. So technically, your occupation is retired. But this creates a very unique opportunity for real estate investors to not put retired as their occupation, but to flip it over to active real estate investor and potentially make some of these really unique elections, allowing you to bring in over 150,000 in adjusted gross income each year and not be limited to the amount of real estate losses that you're accessing to offset tax liability on that retirement income that you're collecting. So, but yeah, absolutely, Bill. It's most important to sit down with your tax advisor and map out these strategies and not just go through the program and start clicking boxes yourself.
And a lot of families, real estate is their business. Mm-hmm. So Josh, a big thing about family businesses is succession, shall we say. And right. We had a really interesting thing happen recently, Proposition 19, which changed the transfer of property between parents and children. Can you explain Prop 19 to us, please?
Sure, happy to do that. I'm sure Prop 19 made Bill very happy if he's looking at picking up probate sales, because really Proposition 19 was sort of sold to the public as a way of, fighting forest fires and a way for people to be able to take their tax base that they have on their property for property taxes and transfer it to other properties. And it does do those things, but one of the bad things that it does is make a pretty big change to the property tax when you're talking about transfers between parents and children and grandparents and grandchildren. Most of us are familiar with Proposition 13, which is kind of a tried and true and steady way of transferring properties from parents to children that allowed kids to keep the same property taxes that the parents had. And that was a great tool. And we've had lots of families where we've transferred generations of real property from one generation to the next, keeping, what was great grandpa's, taxes, essentially. Daniel's laughing. He's probably, seen some of these, right? I had one example. It was probably $25 million piece of property in Malibu, and its tax basis was going back to, 1928. And then it continued to get, stepped up over time. And then when Proposition 13 came in, it locked in the percentage of increase. So it really was way out of whack in comparison to what that property would be taxed at if it if it had sold or it had transferred. And we were able to transfer that. That was mom and dad's primary residence, and the kids kept the taxes of maybe $10,000, $12,000 a year. Much more than that if they were to actually, pay the real taxes. So now under Proposition 19, that's all been changed, right? And the way in which it's changed is, transfers from parent to children are still permitted. You can still, quote unquote, keep mom and dad's tax base, but they don't just let you do it in an unlimited way like you could before. Now it's essentially $1 million credit as to what the property taxes would be. So it can make a huge difference in transfers and whether or not it makes sense to transfer property. Other properties, things that are not mom and dad's primary residence, and property that won't be the recipient's primary residence, don't get that treatment at all. So the property that mom and dad have rented for decades, if it gets transferred to the kids, that's now going to be stepped up for property tax purposes, and the city or county is going to be looking for their increased property taxes based on an appraisal.
I remember friends, colleagues scrambling to adjust their intergeneration transfer of wealth because of Prop 19 last year. And are there ways to avoid this massive shock in property taxation?
Yeah, so we were very, very busy along with that, probably helped some of those people because, every client that had really heard about it, and we did our job to try to educate people about it. But, everybody that called said, oh my gosh, I need to transfer my property right now to my kids. And, we do it today because if not, they're going to be paying all these property taxes. Generally speaking, the way that we approached that was saying, okay, well, let's look at it from a big picture, right? Because if we do a lifetime transfer, and Tony can touch on this, if we do a lifetime transfer, we're now transferring your basis to them, right? As opposed to letting you get an inherited asset. So if the kids are for sure going to keep it, it's one of these assets that, they can't imagine selling ever, then maybe it makes sense at that point to do a transfer and to try to get it locked in, and maybe even now to try to get it locked in. But if this is just going to be liquidated, or we don't know what the plan is, typically our advice is let's not lock ourselves into that low basis, because basically anytime you do the analysis, the stepped up basis is generally worth more than the savings that you might achieve by doing some kind of transfer that keeps the old property taxes. But there are some ways that we do some planning around that. But, I see some heads shaking. Bill, Tony, did you guys sort of have some of the same experiences when you were talking to clients about it?
Yeah, just for the record, I didn't support or against the Prop 19. I may be a beneficiary of it, but I wasn't involved in the campaign for it to come through. I'm a California resident like everybody else here. But I think your advice is right on. And I often have customers who tell me, oh, they did something without advice of a professional to avoid property taxes. And I feel like, well, you certainly saved the crumbs, but you threw out the cake. And I think the cake sometimes can be the step up valuation. So it all varies, and every situation is unique. And that's why you need to have a professional you run these things by. And I think I'm good at maybe identifying potential problems, but you need a professional who's really going to walk you through and evaluate those to get the right solution.
And that's why we have tax professionals like Tony.
We get these questions a lot where parents call in, they want a consultation, they want to start transferring wealth or assets to their beneficiaries. And we really need to map out the value of the properties, the value of the assets, just to make sure that if they do start transferring those assets, and we're in talks the whole time with an estate or a trust attorney to make sure that we are not overstepping or exiting our lane of expertise here. But a majority of the benefit around death and assets is the full stepped up basis upon date of death. And that is just a massive exclusion. And it's the same kind of thing with the 1031 exchange kind of example where clients are thinking that exchanging or selling a property, right? If they sell it outright, you pay the tax on it. But if you do the 1031 exchange, you're kicking the tax can down the road until you kick the can, right? And so a lot of clients get into this kind of conundrum or this confused state where they're thinking, well, why don't I just exit out with all of this cash before I die and then give the cash to my kids? Well, the greatest thing that you could do is actually die with the assets and leave the assets for your children, because then there's no tax liability up to a certain exclusion. So that stepped up basis is one of the holy grails of the Internal Revenue Code. And it's a massive threshold. So once again, Bill, great point. Have this conversation with your licensed tax advisor prior to making any of these major financial decisions.
And let me touch upon what you talked about 1031, a big mistake that people do with 1031 exchanges, which is taking their profits from previous property transactions and taking them to the next transaction without having to pay taxes before doing that. Is that they do a 1031 just for the sake of saving taxes perhaps, but they go into a property they really didn't want. And that is a huge mistake I've seen over and over again, or they go into an asset they are not familiar with, or they go out of state where they're uncomfortable. They do it all for the purposes of saving taxes when they could have talked to someone like from Tony from Robert Hall Associates, which might point that out to them, because they don't ask themselves those down the road questions.
Every single time I've ever done a 1031, the customer identifies 3 properties, one they love that they never get, and then it's either the second one they're okay with they get, or the third one they had to come up with a third and they realize they really don't like it. Every time. I've never had a customer ever, in my experience, now I'm not talking to institutions where they're buying so much property they have to do it this way. I'm talking about individual investors. I've never had a customer come back to me after that and say, well, that was great. I'm really happy with my investment now because I saved money and I got a great investment. I've never had that happen in my career.
And as an investor, I would be the guy at the 43rd day of identification. If you haven't found what you like, let me roll up my sleeve here. Which one would you like to choose as your temporary interim step? And I'll help you with that, because you're right, Bill. So few people. The biggest mistake to make is they sell their property, then they go look for a 1031 property to exchange, and when they should identify their future property before they ever sell their previous one. Thank you so much for bringing those points up. Circling back to buying the properties, hey, interest rates have gone up. Does anybody notice that? So, Daniel, what do the tea leaves tell you is going to happen in the future? Are they going to go up to 10% like it has been for much of my career?
Yeah, I mean, I think we do finally have some encouraging news to report on interest rates. Keep in mind, the arch enemy of interest rates is inflation. And as inflation skyrocketed, so did interest rates, just the way gas and lumber and other consumable goods got more expensive. So did the cost of capital. So did borrowing money. That got more expensive as well. And we were all anticipating that we'd have some positive news as it relates to inflation in the last quarter of 2022. And sure enough, the last 2 CPI reports showed positive news, and we saw inflation beginning to curve, which took some pressure off the 10-year treasury, and we saw interest rates begin to drop. 30-year fixeds are still flirting in the mid to high 6% range, but they're off of their, mid to low 7 peaks of about 2 or 3 months ago. So I think we're finally starting to see some light at the end of the tunnel as far as interest rates go. There's a CPI report coming out tomorrow that'll be hopefully additional good news so that we can see this continued downward trend. I think we're hoping to see the 30-year fixed with a 5 handle or a rate that starts in the 5s in hopefully Q4 of this year or maybe early 2024. That's what the MBA is projecting as of right now, the Mortgage Bankers Association, which will probably bring a ton of buyers back into the market. So I've been sharing with a lot of my real estate partners, many of them who are on this call, that I feel like there's a small window of opportunity here, probably 3 to 6 months before we potentially get back into the nuttiness of 2020 and 2021. Right, a lot of people did get priced out with the higher interest rates. A lot of people put their search on pause, but I feel like as soon as the news and LA Times and they start printing articles about interest rates trending downward and maybe in the 5 range, we're going to potentially see the flood of buyers that thought they missed the boat come back into the market. There is unprecedented demand out there. There's no doubt that the buyers are out there. We're, some estimates put us 4 million homes underwater just to keep up with current household.
Underwater, Jimmy, when we hear underwater, that means
Well,
that
yeah, no, not equity position, but 4 million homes that need to be built and created to keep up with the demand that is out there and with the households that are being created. So yeah, not underwater from an equity position. Equity position is at an all-time high, actually. And so, I feel like there's this window of opportunity for buyers that, can get in the next 3 to 6 months, lock in probably a lower home price today, albeit with a maybe higher interest rate, but they can solve for that, obviously with a refinance down the line. So, there's probably a little window of opportunity here for the smart buyers that are going to get into the market.
So you think that the CPI, the Consumer Price Index, will affect interest rates, are going to affect interest rates in a positive fashion, meaning have a downward pressure upon them. If the Fed increases, which they are still talking about doing, increasing the federal rate again in March, do you think that that'll increase the interest rate? And if it increases the interest rate, we have this tremendous demand, but now we have a cost of borrowing over twice as much as what it was a year ago.
Yeah, I mean, the Fed has a microphone. They like to speak very loudly, and a lot of what they've talked about is kind of already baked into the market, I believe. The one shoe that hasn't dropped is unemployment, and they're wanting unemployment to peak a little higher before they pull back on their Fed rate hikes. And so we're dealing with a recovery coming out of a health crisis, not a financial crisis. And so you're seeing unemployment still maintain very low levels. And a lot of people are arguing whether the Fed should continue hiking interest rates and hiking the federal funds rate pending a drop in or an increase in the unemployment rate. So a lot of debate going on there, but I think a lot of what they've already projected, the next rate hike likely to be somewhere in the 50 basis points neighborhood. That's kind of already baked into the market. But if tomorrow's CPI report shows continued downward trends in inflation, and we see inflation continue to curve, we're likely to see the 10-year treasury drop, and we're likely to see 30-year fixed rates continue their downward trend.
Okay, and 50 basis points equates to 0.5%.
Correct.
Right?
Yes.
Okay. Thank you very much. Circling back to Bill, hey, how about statistics? He brought up some statistics. Can you tell us about some statistics that you have at your fingertips?
I don't know if you can let me share my screen, but I think towards the point of where rates are headed, I'm not one to predict where the market's headed. I like to look at the data and see where we are now and where we should be. One of the key, let's see here. I'm not about to share the screen. I saw a fantastic set of data.
You have these charts in your podcast. So
yes,
let everybody know.
Yeah. Come my podcast or my email at Bill Gross EXP or my YouTube channel. I do a weekly email and video on the market. One of the key stats is the distinction. Okay, and share now. Okay, good. Let me try this real quick. There we go. So here's a fascinating chart that shows mortgage rates versus the Treasury bill that Daniel was just talking about. And one of the things that's fascinating is that normally mortgage rates and the Treasury bill there's a relationship between the two, meaning the interest rate that the government gets on its debt versus the interest rate that homeowners get on government insured or quasi-insured mortgages. There's a relationship. It's not exactly the same, but it's been fairly consistent. If you look at all the blue dots that are basically on the same spot, and there's a few outliers. Look where we are now. The red are the outliers where the mortgage rates are unusually high given where the treasury bills are. And part of that is the anticipation of where rates are going. Part of it is the mortgage industry only has so much capital. And so there's a theory that the mortgage companies are having to artificially charge high rates because they only have so much money to lend given the environment. And if things just stay the same, mortgage rates should come down about another 0.5% or so given where they are. And so we've seen in the last week, rates go from 6.5 to 6.25, today they're at 6.15%. But I do think there's a lot of concern, and I do think Daniel's right that the CPI, we're seeing prices dropping in commodities and certain things, houses as an example, but the mortgage rates I think have been stubbornly high compared to where they are historically in relation to U.S. Treasury bills. I think that's going to be a factor that all things equal. Of course, everything changes every day, but all things equal, we'll see a little bit of a reduction or continued reduction in mortgage rates here in the next couple of weeks.
And thanks for that. And I just want to point out to everybody that they can get information like this in your podcasts that you provide weekly, correct?
Well, I do a couple of things weekly. One, I do a weekly email and a video on the market every Monday, a real estate market update. So if you're interested, just reach out to me at Bill Gross EXP. Be glad to get you all the right links and such.
Very much. I'm gonna change here slightly and come back to Joshua. Josh, the transfer of properties from intergenerational transfer of property. How can I leave properties to my heirs without setting up a fight over the property or forcing a sale? I know in my experience as a real estate investor, some of my best opportunities have been because family members it's going on right now. Family members fighting over real estate that's been left to after the parents have passed. What can people do to, eliminate fights which cause a rift in the family for the rest of their lives?
Well, you'll continue to buy properties that way, Bill, regardless of how I set plans up for the most part, because that is just baked into families. I've seen these types of fights forever. We get involved in these fights a lot. Good planning can deal with it in a big way and can help. I'm sure, Bill Gross, you've probably bought many properties because there's a disagreement or there's a problem. Probably a lot of the people, participants as well, and attendees. But generally speaking, there's this sort of, I don't know if it's a false sense of hope or security or what it is, but parents tend to think that even though their kids have never gotten along in their entire life, that they will suddenly do so upon their death.
When money is involved.
Right. Yes, that money will fix it. Right. Yeah, sure. Generally, we see, and kind of this is a generalization, but mom and dad were the glue that held it together. The kids were barely, talking as it is. And, then we have this either portfolio of properties or even just the family house, split among 7 siblings. Inevitably, 2 want to keep it, 3 want to sell it, and a couple other ones are in jail, can't be reached. I mean, that's the typical, structure, right? And when that happens, we got to figure out, well, which one of the nieces or nephews is living in the house for free? What's all the deferred maintenance that's been happening? Where's the tax sale? When's that happening? So there's just all this stuff that occurs. And if you bury your head in the sand, it's never gonna change. So really, speaking to your advisors, talking to your estate planning attorney, determining what, really you want to have happen to this property upon your death. And if there is a child, for example, that does want to keep the house, that is going to ultimately live in it, I've always encouraged clients to just have that conversation directly, right? Because there's all these gyrations that I have to do behind the scenes if somebody passes away and one of 7 siblings wants to purchase the property, especially if we're trying to keep the same property tax, right? It's very difficult to do because the assessor views it as a purchase from 6 of your other siblings as opposed to a transfer from mom and dad.
Oh, so, can you please repeat that one again? Because that one I know people are not aware of.
Yeah, so let's say the set of facts, right? We stay with our same example. We have 7 kids. One wants to purchase the property. Well, if that happens, right, and let's say everybody gets along, we're not even going to bring into the fact that we have some disagreement, but everybody gets along, and the trustee or the executor, whatever it is, says, all right, fine, we're going to do that. Tommy, you're going to buy the house, and the rest of the kids are going to, money, right? Well, unless that's done in a specific way, and we can talk about it if there's interest in that, the assessor's office views that as mom and dad left the property to 7 kids and 1 child is keeping it. Therefore, it's a sale from 6 of those siblings to the 7th. And they would reassess 6/7 of that property. And they do this all the time. This is not, something you're going to get caught in. This is the standard default way that they view it. And unless you do something to either directly give the child that property and then equalize the other remaining children with cash, or you put language in your documents that allow for these type of non-pro rata distributions, so that you can do something behind the scenes, you're going to be stuck with that, where the child thinks they're getting this great deal and they're going to get to keep the property tax, but in fact they're not. And the assessor will quickly send them an escape tax notice and say, thank you, we've determined your reassessed value and here you go. And then even if you want to appeal it, 1, you'll lose, but 2, you're just going to be stuck in the loop of the assessor's office. But there are ways in which you can plan around that. One is directly leaving the property to the child that is ultimately going to be the one to buy it. If that's not a doable option, then making sure your trust or your will or whatever you're using has language in it to allow for these types of after death transactions between the siblings.
So let me go back to that one, because we hear all the time, use a family trust, put the property in the family trust. And if you use the family trust, then this intergenerational transfer will happen. Well, hopefully there are some tax ramifications. I understand. Let's say that. What are the ramifications if we use a family trust to transfer an asset such as the family house to the children? Yeah. One of them wants to keep it.
Well, trusts are great. I mean, that's what I do, right? Is create these types of trusts, deal with clients and help them through, estate planning, trust administration, probate, all of that. I mean, this is my world daily. The big issue that we run into is particularly when the assets in the estate are not even. And I'll explain that. So if we're to keep with our example of the kids, let's say we have a piece of property worth $1 million that one of those siblings wants to buy, but we don't have other assets in the trust to be able to distribute to the other beneficiaries to equalize them, right? Because one child is going to get a piece of property worth $1 million and the others are going to get what? The trust has to have other assets to equalize the beneficiaries. So that's really where this problem comes in. If the trust is flush with cash and there's all sorts of assets and we can do a lot of horse trading, and you take this and I'll take that, and then it's not as big of an issue. This really comes up when you have a smaller estate where one asset, like a piece of property, makes up the bulk of it. And that's where you need to engage somebody like Daniel or somebody else to increase the value of the gross estate by taking out a loan as trustee or administrator or whatever. And then, basically getting an influx of cash into your estate so that you can distribute money to some beneficiaries, and you then would distribute a piece of property subject to the loan to the other beneficiary. It's really a messy solution. It's much better when you can plan ahead of time and either deal with that through, making sure your estate has enough value in it to equalize children, or if that's less of a concern, just making sure that things are going where they're supposed to be from the start.
If you use a trust to pass it on intergeneration wise, does that trigger a reassessment of property tax?
It can. Yeah, it depends on the type of property, right? So if it's, let's say it's mom and dad's, and we're going back to Prop 19 for a second, but Prop 19 is still not understood by most realtors, by most, attorneys that are even doing my job. It's still very much a, this wild, wild west, which is interesting. It's been around for a year and a half now. But if you are, if it's the primary residence, it's mom and dad's house, right? And, or whatever. And it's going to a child, that's fine. That is covered under the protections, if you'll call it that, of Prop 19, assuming that that child is going to fill out an affidavit and make it their primary residence within 12 months of mom and dad's date of death, right? And the value, the jump between what the county assessor had it valued at mom and dad's date of death to what it's currently valued at on that date of death isn't more than $1 million. If the jump is more than $1 million, then they'll just apply a credit.
I heard you and I didn't quite follow that. So when mom and dad passed away, are you saying that it's not reassessed at that moment? Or it is reassessed at that moment, or reassessed when the child decides to live in it?
So the way that the assessor looks at it is like this. Every property in California has a tax base year, and it has an amount of property tax that it's paying, right? That base year is really what has always given you a savings in California. And that's what you're transferring under the old rules with Prop 13 to your kids, right? So when you under the new rules with Prop 19, unless that base year can be adjusted to current base year, unless you meet those requirements under the new rules. And those requirements are, it had to be mom and dad's primary residence, and then it has to become the child's primary residence within 12 months. If you meet those requirements and you fill out the necessary documentation, the assessor will not change the base year. They'll leave it alone. But there is $1 million credit now in there. It used to be unlimited. Now they look at whether or not the difference between the old base year and the new base year generates more than $1 million in difference in value. If it does, then they will reassess it to the current base year's value, and they will apply $1 million credit. So that old example of the Malibu mansion for $20 million with a base year from 1928 that just got increased, that no longer works, because the difference in value between what the assessor had it at and what it would be worth at the time of death is well in excess of $1 million. So the only thing that family would get at this point is $1 million credit of base year tax towards whatever the new assessed value is. Does that help?
Oh, that helped me. Ladies and gentlemen, what it means to me is, any questions? Call Josh. Because Prop 19, like you said, it's a wild, wild west. It is vastly misunderstood. And
it is, yeah.
And they really need to make sure that they don't make a mistake that could be quite costly.
Yeah, and every county is slightly doing this a little bit differently. Even though this is handled by the Board of Equalization for the most part, the county is in charge of how this is applied, right? So we see slight differences in how LA County does it compared to Riverside County, compared to Kern County. So you really need to look at, what's going to fly where you are, and what is that county going to be looking for. Some of the tools that we use to sort of try to bypass some of this reassessment has yet to really totally be tested. We know that it's working because we're not getting reassessments on certain situations, but we've yet to see the assessor really take challenge one of these types of transactions and transfer. So you need to be working with a professional from all sides, tax side, the real estate side, lending side, attorney side, that really understand what you're trying to do and can work as a cohesive team. That's really the important piece.
So I just want to make sure I understand this correctly. That $1 million credit would be, mom and dad bought the house for $100,000, and it can be protected up to $1.1 million. Now that's
basically. Yeah, that's a good way to think about it.
Add $1 million to it. Okay.
Mm-hmm.
Thank you very much. Wow. Property taxes and taxes. Tony, let's circle back to you. I'm a real estate investor and I own rental property. What are my top real estate rental deductions that I can take without triggering careful examination?
Sure. So aside from the ordinary deductions of mortgage interest and property taxes, a lot of times clients will acquire their first property and have many questions about what out of their expenses, including just ordinary operating costs, cell phone and internet and whatnot, how they can allocate some of these expenses towards their rental income or cash flow. The top 5 tax deductions, though, I talk about these a lot in my webinars. One for rental properties, at least here in Southern California, for a majority of our clients, a big cost to them is marketing and advertising. And a lot of people don't realize that when they have a vacancy and they promote this property to get a new tenant in the property, that all of the marketing and advertising costs are going to be dollar for dollar tax deductible against rental income. Number 2 would probably be professional supplies and equipment, supplies that you have to purchase for the property. And this is both on the Airbnb kind of short-term rental side as well as long-term rental side. If you need to buy new appliances, even if you had to buy a new computer on your end to keep track of the cash flow and the expenses, and you have QuickBooks or a Buildium, whatever property kind of software you're using, professional supplies and equipment, a very commonly deducted expense. Number 3, car and truck expenses. If you're actively managing your property portfolio and you're driving to the properties, you're going to Home Depot, picking up supplies, driving to meet with, attorneys to set up trusts and estates. A lot of this mileage deduction or auto and truck expense would be a tax write-off as well. Number 4 would be probably the common deductions of improvements, and we could wrap in utilities and whatnot. But number 5 is the one that I actually changed about 2 or 3 years ago in my list of the top 5 deductions. Number 5 would be bonus depreciation for properties. Back in 2018, a part of the code was altered, not 2018, 2020, during the pandemic year. The federal government introduced something called QIP, qualified improvement property, and it mainly pertains to commercial real estate. But on the individual residential rental side, there's something called cost segregation, which allows you to essentially reach forward into future years and accelerate future year depreciation to take the deduction in this year, rather than waiting 27 and a half years, or for residential 39 years for commercial, rather than having to wait that whole time frame to take these deductions. And for the veteran investors in the room, I know you're probably thinking, well, why would I want to do that? Then I'm taking away future deductions. And if I ever sell the property, I'm going to have to recapture that depreciation and pay tax on it. Well, a majority of my clients, I'd say probably 90+% of my clients nowadays, are worried about maximizing the deductions now in the present time. And they don't ever plan on selling their properties. They just plan on, once again, kicking that tax can down the road until they kick the can by just 1031ing that property over and over and over again, maybe going from a single family residence into a 4-plex, and then taking that 4-plex and exchanging it into a 10-unit building, maybe elsewhere in the US. So bonus depreciation has become probably one of the more popular deductions for rental property investors. And just to give you a couple stats here, in my career of over a decade and a half working here, I did more, or I filed more tax returns with cost segregation elections in the past 2.5 years than collectively over my 18-year career here at Robert Hall. So you can tell that people are becoming more, I'm not going to say concerned, but more interested in these creative tax strategies and elections that can be made on the return. And bonus depreciation has changed since the beginning of this year. So in 2020, it was at 100%. The federal government is starting to wind that down. They are dropping the 100% bonus depreciation limit down to 80%, and then 60% in 2024, 40% in 2025. It's set to fully exhaust by 2027. But I foresee, just from a professional opinion standpoint, I do foresee this being changed in the next year to 2 years to bring back that bonus depreciation benefit. Maybe not to the full 100%, but maybe locking it in at 60 or 80%, which is still a massive adjustment. It's called a 481A adjustment. And that, once again, allows us to, these deductions, depreciation is a phantom write-off, right? It's not something that you're coming out of pocket for and taking the deduction as you're paying for utilities, right? You pay $1,000 in utility bills, that's $1,000 out of your pocket, $1,000 write-off. For this bonus depreciation, you're electing with the government to look forward into future years, deductions that you haven't even taken yet. And these are phantom deductions, so not actual dollars coming out of your pocket. And you are accelerating that write-off in this year to reduce that cash flow. And with that tax savings, my hope at least, is that with that tax savings, you're cycling that back into another investment or maybe in a 1031 exchange, bringing cash into the deal and going from $1 million property into $1.6 million property, increasing your depreciable basis, and then on the new property, making the cost segregation election again in the new year, allowing you to offset that cash flow. So those are the top 5 write-offs. Number 5 just happens to be one of those. It could probably be a 2-hour seminar just in itself, cost segregation and bonus depreciation. But those are the main things you want to focus on as a real estate.
I'm still not clear. Could you please explain what cost segregation is again?
Sure. So when you buy a residential rental property, you have a 27.5-year lifespan to depreciate the building value, just the building, not the land, but the building value over 27.5 years. That gives you the value of the building as a write-off each year for just shy of 30 years. That's on the residential side. And it's a phantom expense, right? You're putting a down payment on the property, you're financing the difference. But let's say the property is $1.5 million, $500,000 is land value, $1 million is the building value. The federal government gives you that $1 million amount spread out over 27.5 years as a write-off each year. Massive, massive deduction, right? For commercial, it's 39 years. So instead of waiting 27.5 years to take that full $1 million write-off through cost segregation, a third-party analysis or a third-party company will come in and analyze that $1 million valuation and separate out any depreciable improvement that has a depreciation lifespan of under 20 years. So 5, 10, 15, or 20 years that can be accelerated and taken all in 1 year. Once again, I'm being very blatant with my explanation, but let's say that out of the $1 million through cost seg, we're able to accelerate, I don't know, $600,000 of the $1 million. That's the 481A adjustment that we take as a write-off. That gives you a $600,000 federal and state write-off, dollar for dollar, in this calendar year, let's say, or actually this would be for 2020, because you could still do the analysis for 2020, by the way, even though we're in 2023. That's one of the kickers here. So let's say $600,000 is taken fully for 2022. That wipes out all of your cash flow on all property investments. So if this cost seg is just on one property, but you got a 15 property portfolio and all of your properties are cash flowing, that 481A adjustment on this one property will help offset cash flow on all of your other real estate investments as well. Now, your depreciable basis in the building is no longer $1 million, is it? Your depreciable basis is now $400,000. That remaining $400,000 is depreciated over 27.5 years residential, 39 years commercial. And when you sell that property down the road, yes, you will have to recapture that depreciation and pay tax on it. But for the real estate investor who understands the benefit of real estate and never selling it, and if you are selling it, you're selling it in an exchange or tapping into equity and buying more property, you'll never have to recapture that depreciation, because in death, once again, we talked about this a few minutes ago, in death, your heirs will receive a stepped up basis depending on what the estate exemption is at the time of death. And your children will receive the tax benefit. So the benefit tax-wise really on the value of the property is not meant for you. In my opinion, it's meant for your heirs, your next of kin. But in the immediate present, yes, this cost segregation election has been a super popular election to make. And once again, it's probably a 2-hour webinar just in itself. But these are opportunities for you as real estate investors to really create more tax shelters for you to offset cash flow.
And I see another benefit to cost segregation is if you take that cost segregation benefit today, the deduction today, you're taking in today's dollars, which as a result of inflation are more valuable today than the dollars tomorrow.
Absolutely. Great point.
I want to circle back, because when Josh brought up about the fact of a family member wishing to buy the family house, and maybe they should tap into someone like Daniel to borrow money against the house. Daniel, what kind of loan programs are there out to deal with such a situation? How would they work? And well, in addition, what are the loan programs are there out right now to deal with these higher interest rates?
That's a good question. You know, one of the silver linings, I think, in all of this with higher interest rates, it's forced lenders to innovate product. And, you know, we've been able to solve for both higher interest rates and come out with products for investors that help mitigate some of the challenges that we're seeing today. First, I'll kind of touch on the buy down program, which has become very popular. A buy down program basically gives a buyer a graduated payment over time, affording that buyer significant payment relief for the first few years of their mortgage. And if you really subscribe to the narrative that with lower inflation will come lower interest rates, the buy down program gives you ample time to set yourself up for a refinance in the future and secure a long-term lower interest rate. So these buy down programs have become very, very popular. If your note rate was going to be 7, you can start with a rate of a 4 for the first year, 5 the second year, 6 the next year, and then 7 for the life of the loan. But most people will likely have the buy down loan for maybe a year or two, and sometime within the first 12 to 18 months, they're refinancing into just the normal 30-year fix, hopefully with something in the 5 range. So go ahead.
What would be the cost of these buy down programs, and could that be a negotiable point with working with a seller that, hey, buy this down so we can
Great
afford
question.
purchase?
Yeah, great question. It does require some seller cooperation. Sellers are required to cover the expense of the buy down. And so, we haven't seen many seller credits during 2020 and 2021. Everybody was making offers free of all contingencies and 14-day closes.
Without even looking at the property.
Right, exactly. Markets shifted a little bit, and we're seeing sellers come to the table offering credits to get deals closed. It's also very popular. I'm telling all my real estate partners, don't reduce the price on your listing before you consider reducing price. Put a seller credit out there, because if you take $1 million listing, for example, and you think you probably have to lower it, maybe 5 or 10% to get that property moving, and lower it potentially $100,000, lowering that sales price by $100,000 may have a small change or shift to that potential buyer's payment. Maybe it drops it a few $100. If you offer a $30,000 seller credit in lieu of a $100,000 price reduction, that $30,000 seller credit will drop that buyer's payment by over $1,000. So, for a seller, I'd rather give a $30,000 credit than drop my home price by $100,000. And if I'm a buyer, I'd rather take a $30,000 credit and get some payment relief for the first few years. So it does require a little bit of seller cooperation. As far as programs for investors, it's funny, there's always been this adversarial relationship between mortgage advisors and accountants, and all the mortgage advisors and accountants on the call know exactly what I'm talking about. We'd get so frustrated because all the client wanted to do is buy a house, but we would see these very creative tax strategies on the tax returns, and buyers and clients didn't have enough net taxable income to qualify. So through product innovation, we've been able to solve for a lot of self-employed borrowers and real estate investors whose creative tax strategies would typically rule them out for lower cost traditional financing. And so, we've been able to leverage products like the bank statement loan, the DSCR loans, debt service coverage loans, bridge loans, to help solve for this. And it kind of lets everybody have their cake and eat it too. You can have Tony and his team deploy the creative tax strategy, all while having access to good loan products with good loan terms. And so these products analyze a client's income in a different way, a more aggressive way. Bank statement loans are looking at business-related revenue into the borrower's business bank statement. DSCR loans are taking into account potential and future projected rental income. And so there's a lot of great products out there. Our partners at Civic Financial have been great partners for us, and many of our clients, they've empowered us to really allow our clients to scale, right? I think one of the things that everybody wants to do if they're starting to dip their toe into real estate investing is, how do you scale? How do you get to that next level? And so I think through product, through good partners, through people who do this on a daily basis, you have access to being able to scale, right? Having access to credit and capital is super important. So, I think that's the one thing that I actually, through all of these challenges, we've seen product innovation. We've seen us lenders forced to come out with ways to solve for today's market.
Well, now, if you were to lend in the example that Josh was talking about, to a trust has one family member that wants to live in the house and distribute cash to the rest of them, would it be just as if they were buying the property? They would be for a loan program, you would qualify them as if they were essentially buying the property, fully qualify them?
Sure. We've worked with Josh and many of his clients. Every situation is a little different depending on how the trust is set up, but we've used both conventional products to allow we always often see this, when there's multiple siblings, right? So we've often used conventional products where one sibling wants to essentially take out a cash out refinance, pay off other siblings, and keep the property. Sometimes, depending again on how the trust is set up, we may have to deploy private money in order for that exchange to happen.
So
Private
you
money.
guys also have private money that you lend out too?
Correct. Yeah. Through our partners at Civic Financial, we offer private money and hard money solutions as well. And so, Josh will kind of tell us how the trust is set up, and we'll figure out the most equitable and lowest cost solution to allow that family to make that move. Usually, again, if we're deploying private money, it's just kind of a bridge loan. It's a temporary loan to let that family settle out the trust, and then we'll go in after and refinance that client out of the private money and put them into a conventional product.
Yeah, most of the time it's a private money transaction just because of the underwriting guidelines and the speed that we might need to be at. I would say it's the conventional side comes in once we've done the transfer, gotten it to the sibling that is ultimately going to be the buyer, and then they're refining and taking out that hard money loan, and kind of dealing with it that way.
Yeah. Now we've been talking about growing. We already have a real estate portfolio and it's already grown. Bill, how can someone getting started, how can they create a business or income in real estate? And where are the opportunities right now? And if I have some extra money, maybe up to $50,000, where can I invest it at this time?
I think in any transformation, when you want to change from something you're not to something you are, that's transformation. I think you have to have three things. So when people ask me how to get started in real estate, I tell them these are three things you have to have. You have to have a leader or a coach or a mentor or a visionary, an author. Bill Tan, you're a good one. I know you do a great job and have meetings in Pasadena, and there's some others I refer to. I think second, you have to have a community of people or colleagues or a team or other people in the same process, maybe some ahead of you and some behind you that motivate you and support you and push you on. And third, you have to have a system that you follow. And so there's different combinations of those three, but you have to find the one that you feel and you trust and you're excited by. So I encourage people to go to your real estate meetup. I go to another one that you spoke at last month. And actually I meet Robert Hall there monthly as well, not Tony, but his staff is at the LA Real Estate Association event tomorrow night, Thursday night at the Iman Center in Culver City, LAREIC.com. And I point those out because I'm not really in that business, but I want people to find their path because I've invested in real estate, but I'm not really in the business of taking people by the hand and walking them through. I'm making money investing for my family in the future, but I've seen those paths and I've seen consistently certain people do a good job of teaching people and bringing them along. So I would say the event tomorrow night's a good one. Bill Tan and his event's a great one as well. But you have to find somebody that you believe in and support. And I think that there's opportunities to invest with other people rather than do it on your own. I met a gal the other day who's starting out and she wants to syndicate multifamily because based on her research, that's the best way to make a lot of money. Well, that is, but it's very complicated, takes a lot of work, a lot of expertise. And what I've done, and money, well, maybe money or other people's money. And so what I've done is invest my money with those experts. I invest as a limited partner with people who are experts in those areas, and I get a nice return. I don't make millions, and I don't make 10 times my money, but I make a very good return on it. But I also learn from them what they do, and that helps me make the best investment next time. So I really think it's important to have that coach or mentor and a group and a system. And again, Bill, I'm not sure if you're going to present your program here or how to reach that, but you have a great one, a great reputation in Pasadena area. Like I said, the one I go to in LA as well, and I know Robert Hall's group is there as well tomorrow night. Those are my best recommendations on how to get involved and get started.
Thank you very much for promoting. I just put it in the chat. We have right now we're not meeting live. Our next live meeting in person will be in March. But we're meeting monthly free Zoom meetings right now. And I'd put the link in. Thank you very much for that. A big mistake I see is people just diving into real estate and quitting their job. How would somebody go from a 9 to 5 full-time to real estate as an investor, Bill?
Oh, I don't see that as a mistake. I think that, we live in the greatest country in the history of the world as far as opportunity. And I think that
they know nothing. They know absolutely nothing. And then they didn't.
I taught my daughter to swim by throwing her in our pool when she was an infant. And I think that there's different ways to learn, and you have to do what's right. And again, it's who you trust. I know for me, I had a salaried position and I had to just jump in the full commission world. I do think you have to find, a system where they help people make that transition. So for me, I started as a mortgage lender, 36 years ago, but there were other people like me who went from salary jobs to mortgages because you had a lower, at that time, it was in-house for a bank, you had a lower commission split, but you had more volume and you had more chance to learn the business. And I also looked at it as that beginning 6-month period was like going to college. At college, you either pay tuition or you have to earn a scholarship. In some jobs that pay commission, you're not paying them anything, but you'll get paid unless you close business. But that's better than college. You don't get paid at college no matter what you do. I guess unless you're a football player. So my point is, I would say that if you have the burning desire to make it, you have to be responsible, and depending on your family responsibilities and such. But I would say that for me, there's much less risk for me as an entrepreneur today than there is for me had I been on a salary job where I have to worry about being laid off, cutbacks, mergers, my boss doesn't like me. I have friends who are being laid off in their 50s and 60s. Nobody's gonna lay me off. Now I have to fight every day to get a new deal and I have to work with customers to get new listings and sell property. But as long as I do my work, I get paid. So I would say, it allows mindset. Read Rich Dad, Poor Dad. Make sure you follow, I think, thought leaders on, motivating opportunities. Grant Cardone's one of my favorite coaches. Tony Robbins is another one. But if you're committed to this business, there's no reason why it should take you more than 3, maybe 6 months to the outside to make that transition. I would encourage you, if you have any interest at all, take that leap. Be responsible, but commit yourself to it and do the work every day.
I took a different path. I had the salary job and I did real estate and note investing. And when I made more money investing than my salary, that's when I transitioned out. And I am currently fully unemployable.
Well, there's nothing wrong with that approach. I see too many people clinging to a job they're unhappy with and miserable with and unhappy in their financial situation. I see way more of that who've been asking me about getting started for 2, 3, 4, 5 years than I do see people who make that jump and fail. I don't see that as often. You might think that's the riskier alternative, but I would say in the long run, at least in my experience, that's probably the safer alternative.
You don't mind me picking back on that, Bill? That really resonates with me. I think there's a lot of people that want to jump into real estate, jump into mortgage. They see the opportunity. The advice that I always give them is the same. I heard my partner Ron Sequeira say this yesterday. Attach yourself to someone that you like. Attach yourself to a top producer that does volume, so you can see deals at a high level. And swipe and adapt. Right? Bill Tesser told me that from Civic Financial. Swipe and adapt. And success leaves clues. If you're wondering, why the top agents are doing the volume that they're doing, it's no secret. You can just kind of follow along, see what they're doing, see how hard they're working. They're likely the first people at the office every day. They're likely the last one to leave at the end of the night. They grind harder and smarter than anyone else. They're capitally invested in their business. And, I think really if anybody's looking to just make that initial leap, I would say attach yourself to a solid team that's going to give you the exposure. And like Bill said, it's a paid internship, right? And sometimes. So, it's a question we often get as well.
Yeah, and I think they're all lucky. You know how you spell lucky, right? WORK.
The easy way is work hard every day. That's the easiest way to make a lot of money.
takes a discipline some people don't have, is to work hard every day. I want to, Bill, you do something, you have a special niche that I want people to be aware of, and that's probate. Can you talk about that for a little bit, please?
Sure. I think one of the keys in anything you do in real estate, it's such a huge industry, so wide, so many different opportunities, products, geography. They need to really find an area that you specialize in, so that rather than competing, you create more value for your customers. And so for me, about 4 years ago, I committed 100% to the probate and legal real estate space, to be an expert as a real estate agent on particularly selling property where court confirmation is needed, to be able to advise attorneys, families, on when things go wrong and they're suing each other. Well, how do you get out of that with minimal expense? So I work on probate real estate. I also work with estate planners to help people, families, and clients avoid probate by having a good plan in place as well. So for professionals, I host Probate Weekly, which I think is the largest podcast in America in real estate on probate. It's Thursdays, 4 p.m., probateweekly.com. But really, this is an area that's,
You said that too quickly. Please repeat that a little slower.
Sure, probateweekly.com. Every Thursday at 4 p.m. Pacific, probateweekly.com. And I have a Facebook group, Probate Experts. And we help families who have questions and refer them to attorneys and legal services, and in some cases bring them vendors to help them solve problems. But it's an area that I focus in. Every realtor is a little different. I don't take buyers out and show them houses like some agents do. I refer them to friends who do that. But I really work every day with people in court and with attorneys and strategies on how to get properties, either in litigation, how to get them settled to the customer's benefit.
Yeah, probate is quite complicated, and most people think it's easy. And they need to, if they're interested in it, I suggest they talk to you.
Thanks.
Which brings me to something you said, to avoid probate. So I'm going to circle back to Josh. There are ways to avoid probate, and I know gifting is one of them. Could you explain gifting and how I might maximize my estate tax exemption, please? And
Sure.
by the way, folks, this will be the last question, then we'll start fielding yours.
Sure. So just to kind of piggyback on what Bill Gross said, probate it's a process, right? So when people think about the transfer of assets, whether it's through gifting, whether it's through a court process, whether it's through trust transfers, they oftentimes lump it in with probate. They just refer to it generally that way. But when Bill's talking about probate, or we're really referring to the probate process, we're talking about a court, an overseen process by a judge, right? If you're in probate, that means that you have either left just a will, or maybe you didn't have a will, and the court is now stepping in to determine how your assets will be distributed, right? Whether it's pursuant to the will, whether it's pursuant to the law. And you can sometimes get into probate court if you have a dispute, either as to the estate, or as to a trust, or as to something else. So, that's where I spend a lot of my time dealing with these issues, whether it's pre and planning, or it's post and litigation, as Bill talked about. So the ways to avoid probate, there's really kind of only two. You can gift things while you're alive, right? And that's one option. That comes with a little caveat related to what we talked about with Tony, and you're transferring your basis, right? So maybe that's not the path to take, because if those heirs turn around and sell that house 3 years later because they realize they don't want to be a landlord like mom and dad were. Now, they got the asset during life. You avoided probate and the cost that it is, but you blew the stepped up basis, right? And now the heirs are going to have a huge capital gain that they otherwise would have mostly avoided. The other way to avoid probate, and probate being that process of court confirmed transfer of assets, would be using a trust. Right. Trusts are private. Trusts are more contractual in nature. They don't require court confirmation unless there's a dispute. So you can, transfer assets quickly and easily if you have a private trust. So those are really the kind of the best ways to do that. And whether you're, we almost, unless we're talking about a very large estate, which I deal with, assets that are above the estate tax exemption guidelines, so $12 million per person, $24 million married couple. we're really not usually talking about doing a lot of gifting during life. For those clients that are above that, we're doing gifting all the time and looking at ways in which we can maximize the exemption while it exists in its highest form at the moment. But otherwise, if somebody's got an estate under that $20 million mark, a married couple, we're usually not gifting things during life. We're usually talking about doing planning so that something happens at death. There's an easy path to getting assets transferred to the heirs, whomever they may be.
If I can just give a quick advertisement for Josh's service. If you don't have a plan for your assets upon death, the state of California has one for you. It looks a lot like the DMV. It's just not as customer service oriented as the DMV is. It's a lot worse. So if you're okay with that, don't worry about it. You don't need a plan. But if you are concerned about leaving property for your family, then you should talk to Josh or an appropriate estate planner and put a plan together.
Which reminds me, our audience should consider people like you, their circle of advisors that they should use. If not Josh, Daniel, Bill, or Tony, find someone
Somebody, yeah,
not quite as good as them, but in a similar capacity. I missed a question, and I'm sorry, Daniel. A question that was for you too. I had from a financing perspective. What are the top 3 things that a new real estate investor should be thinking about?
Well, that's easy for me. I think I've made a lot of mistakes over the last 20 years, buying, selling, flipping, Airbnb, long-term holds. I've made a lot of mistakes. And I think the one thing that I can take away, or the 3 things that I can take away after the last 20 years of playing in the real estate space and mortgage is, one, understand that it takes multiple villages, and you want to align with partners and experts who know more than you do. You don't want to be the smartest guy of the group. When you're making some pretty large bets and taking some hopefully mitigated risk or calculated risk, but align yourself with the right people. Number 2, I think get the proper tax and legal advice, because it's not about how much money you make, it's about how much money you get to keep, and having the right partners to guide you through creative tax strategies, especially as your business continues to scale. And Tony has assisted me with different strategies that no accountant had ever even whispered or mentioned, and has really helped me ensure that I try to keep as much of the hard-earned money that we've made. And then lastly, and maybe just as important as the first 2, is having access to credit and capital. I talked a little bit about it earlier, but it's incredibly difficult to really scale any business, particularly in the real estate space, without having easy and efficient access to credit and capital. Say what you mean and mean what you say. And if you're going to bring in partners or align with banks or, bring in investors or take out loans, you always want to make sure you pay back your loans and have access to credit and capital at the highest level.
Thank you. I appreciate that. Good answer. I am now going to look at the questions and we will go through them in order. First one is from Rakesh. I hope I'm not, I may screw somebody's name up. It's not personal. Don't take it personal. How far will this real estate dip in 23, 24 before beginning of recovery? Let me answer that. I have a meeting tonight, a real estate club meeting, and it starts at 5:30 with networking, 7 o'clock. Our speaker comes on. The speaker is Rick Sharga from Adam Data. He's vice president. He has been providing real estate data both locally and nationally for like 20 years, and it's free. And the Zoom link is in the chat, so please feel free to join our meeting tonight. He will be talking about an economic update and the real estate market. Chris, I think this might be the Chris I know. Will we see high unemployment this year? I don't think that's a question for this panel, but you can ask Rick that tonight. Will we be discussing real estate syndications? No. And by the way, real estate syndications can be a very expensive thing to get into. Tony, please explain the tax differences between a full-time rental property and a short-term rental property.
Sure. So I have a majority of my personal clients who are rental property owners, obviously over the past, gosh, I don't even know how long, maybe half a decade, where short-term rental investments, the number of filings that we do here at Robert Hall has just skyrocketed. Anywhere from, the desert properties to the beachfront properties to the mountain properties, even here in LA, short term. In fact, just yesterday, I had a client who invested in short-term rentals for traveling nurses. I think he's got properties in Texas. He's got properties in Wisconsin and Wyoming, in Mississippi, Minnesota. I mean, he's all over the place. And these traveling nurses, they are traveling because they get paid a lot more to travel and be traveling nurses, and they don't stay in one place. And the amount of money that he can collect in a 3, 4, 5 bedroom home that's close to a hospital is just the cash flow is insane. I've seen it firsthand on the tax returns that I've prepared for these investors. And from a tax perspective, you have a couple options of how to report this. One, the way that I do it is I report the short-term rentals on Schedule E's. However, if you are not a professional in another industry, meaning that this is your only source of revenue, these short-term rental investments, there might be an opportunity for you to report it on a Form Schedule C, which some of you might think is, well, why would I want to do that? And that is subject to self-employment tax. Well, actually, it wouldn't be. If we file it on a Schedule C, we'd be claiming it as a business. And there's a box that you could check on a Schedule C that says this Schedule C is not subject to self-employment tax. So there's a couple options of how to report that. If it is your full-time business, you may actually want to convert it into something that is subject to self-employment tax, because then it not only allows you to defer money into a retirement account, a SEP IRA, for instance, or a solo 401k with maybe even a profit sharing if you incorporate the business of managing short-term rental investments. I don't normally suggest that. In fact, I think that I've only suggested that maybe one time over the past 18 years that I've worked in the tax industry, and simply because it made sense financially for this individual to do this under an S corporation and operate the self-employed business as an S corporation, maximizing deferred comp, purchasing the corporate assets. And once again, it just made sense for that one individual. But the main benefit for rental cash flow from a tax perspective is the fact that rental income, whether it be short-term or long-term rental cash flow, it is only ever subject to federal and state income tax. It is not subject to Social Security and Medicare tax. Well, Social Security and Medicare tax alone is 15.3%. So if you do end up showing that short-term rental income as a Schedule C self-employed business and don't check the box making it subject to self-employment tax, you're hitting yourself with an additional 15.3% of tax, which is you contributing to Social Security and Medicare. So we could have an argument as to whether or not you're technically not losing that money because you're paying into these social pots that we'll all eventually collect from. But my goal for my clients is to keep as much of that wealth in their pocket as possible. So whatever way to avoid that additional self-employment tax, that's the best way to go. Because in my opinion, that's one of the major power plays for owning rental investments, is the fact that you don't have to pay Social Security, Medicare on that cash flow. But yeah, tax difference, there's a couple different ways to report it, but the most common way is to report it directly on a Schedule E. There's a fair market value rental box where you have to put in the amount of days that you rented out. There still applies the 14-day rule, where if you utilize that property for rental use, so you rent it out, but for under 14 days in the calendar year, the rental income is not taxable. It's called the 14-day rule. But if you do rent that property out more than 14 days, you want to set up depreciation schedules on it. You want to allocate the mortgage interest, property taxes, maybe even do a cost seg analysis on it to help offset any other Schedule E non-passive rental income or investment income.
Thank you. By the way, everybody, we just scheduled an LAREA special meeting with Tony for February 7th, the evening of February 7th. So if you would have more tax questions and want to hear about all the updates, we've got you all set up to listen to Tony for as long as he wants to talk to us. He's willing to talk to us. Edward, your question is not clear to me. How can the real estate status change year over year? Not sure what you mean by real estate status. Is it of the investors, of the property? please clarify it and put it back in the question and I'll circle back to you. Karen, her father passed away 2 months after Prop 19 went into effect. He had 2 properties which she inherited and that she will not live in. She was told by the county that she had no other alternatives but to pay the current property tax rate. Are there any other alternatives, Josh?
Doesn't sound like it. I mean, if the if the facts are that, you know, the transfer, she's not going to live in them, and it was after Prop 19 went into effect, which was February of 21 was its effective time frame. Not really. You know, the ship has sort of sailed there, unfortunately. So, you know, I think this is an example and an opportunity for anybody that's got that type of situation or would see that. That's the value of the kind of that planning ahead of time. But where we have made some room here is appealing the value that the assessor comes up with. You know, they're going to reassess it based on what they believe a fair market value to be. They're going to base that on comps, right? And it's an automated valuation, and it can be wildly impacted by things like a brand new house being built across the street on spec and sold, right? For something way above market conditions for that typical neighborhood. We've seen that sort of drive up, single pieces of property where the assessor's value just isn't in alignment with reality. That's where we can challenge that value, but challenging the application of Prop 19, no.
How about for a property that was inherited prior to Prop 19?
Yeah, if the date of death was before Prop 19 became effective, the assessor is still considering those under the old rules, right? You have a time frame for those, but you would want, there is a way to do that, and you would still be able to keep the property tax in that situation.
Would they need to talk to someone to you about that, or is it already in place?
Yeah, generally speaking, yes, because when you go to the assessor, and there has been a period of time that has lapsed between the death and when you're reporting the transaction, the assessor can sometimes take the position that, no, you missed it, we're going to just apply the new rules, and you have to go back and show them, no, this was a death during this period of time. I've seen houses that mom and dad died 20 years ago, still in their name. And you need to move it.
This is from Kevin. Recently heard a presentation where the financial planner talked about structured installments to avoid tax liability on a sale. Should have read this ahead of time, I apologize. Essentially, the escrow proceeds are sent to an annuity firm for the benefit of the seller, where a structured payment plan has been set up. According to the financial planning firm, the IRS has the view that this would not cause the tax liability to kick in. Of course, the taxes become due as a payment is sent from the annuity to the former seller. Tony, this is right up to you. Do you agree that the opinion that this would defer the taxes due?
I think that what you're referring to, and Josh, I think can assist in this. I think it's a deferred sales trust, or I think that's what
it sounds like.
I know how it's all reported, but Josh, you probably have more detail on those kind of setups. I can talk about the tax side, obviously, but if you want to chime in on this first, and then I'll hop in.
Yeah, I mean, we can keep it general too, because these are so varied. But there are deferred sales vehicles like installment sale trust, deferred sales trust, that basically allow you to make a sale of an asset, put the proceeds into this trust, which is a holding vehicle, and then use those proceeds to do other investment. Real estate can be one, and you're going to be paying tax as the proceeds are distributed out to you. That's kind of the installment sale model, right? California hates traditional DSTs, but there are some wiggle room when you look at other options. There's other types of installment sale trusts that have yet to be quite as attacked. So yeah, I mean, that's the basic structure of it. I think that's one of those situations that Bill mentioned where it might be good to just get us offline and we can talk about the specifics there.
Because I also believe, Josh, because you've talked to, I think, a couple of my clients personally about this, there are some limitations on what they can, like, if you needed more of the money, is it possible to access more of that money, or is it one of those things where it's a consistent kind of distribution year in and year out? Like I said, I know how it's all taxed, but aren't there less, you're more hands off once you go into this, there are more limitations with accessing that money, correct?
It depends on the intermediary, right? The trustee in that situation. I've worked with a lot of them. We like this particular one that's Nevada based that's pretty easy to work with from the perspective of modification. Because things change all the time. So you want to be dealing with this isn't Mickey Mouse cookie cutter stuff. You need to deal with a company that does this all the time, but then also make sure you're dealing with one that's going to be, responsive to modification requests if you need to, particularly if you're not just going to do like a set it and forget it kind of thing.
Thank you.
So speak with Josh.
Okay.
Speak with Josh about it, and then
Josh,
on the tax side, we can map out the numbers.
And then contact information will be, if you don't already have it, it will be put in the chat. Circling back to Edward, he was talking about, can he claim being a real estate professional 1 year and change it as to not being a real estate professional the next year, or vice versa?
Yeah, I mean, I'm not going to say that you can't do that. You probably want to keep things consistent and not flip-flop back and forth each year, just because there are forms that are added and then removed from your return when these elections are made. Because aside from the in-home office form, which has a very high risk for audit, with the election side of things, what you're doing when you check this box, it's literally as simple as checking a box on a return. It's a box that literally says real estate professional next to it. When you check that box, what you're telling the federal government that what you're telling them is that you specifically, out of all of the individuals out there, taxpayers here in the US that show losses through real estate related investments, that you do not see a limitation to what you can deduct as far as losses are concerned. If all of your properties are profitable, there's really no reason to make the real estate professional election unless you are acquiring more properties or continuing to acquire more properties that might show losses through cost segregation, through major improvements or qualified improvement property elections, things like that. But as far as flip-flopping back and forth, sure, you can, but with any like anything under the Internal Revenue Code, you don't want to do that every single year. And I'm not saying, once again, I'm not saying that you can't. It's just probably not best practice to do that. So once you make that election, you probably want to keep that election on your return as long and as far as possible into the future. But once again, I during the pandemic, I had clients leave industries, enter into new industries, and then within a year, they switched industries again. And now 2023, they're all looking at new careers again. I have a handful of clients who went through, 3 to 4 career changes over the last 3 to 4 years. So in that case, if you are switching careers and going in and out of being a real estate professional, where the 51% rule does apply for some years, but doesn't apply for other years, sure, we can make that election in the year where it makes sense. And then we can remove it in a year where it doesn't make sense to have it on the return. So,
thank you. Kevin, I'm going to shorten up your question to the panel. Any thoughts on where the rents are heading? And I will put my 2 cents in first. Everything I've seen from across the country, rents are still increasing, though they are increasing at a slower rate. Just the rent increases are not going down. Anybody?
There was some, if I could jump in on that one, and I think that, I'm generally been person saying, housing crisis isn't here or crash isn't here because of the inventory being a driving factor. But recent stats on rents have just turned down by historic levels in the last 30, 60 days. And occupancies are now like below they were pre-pandemic for the first time. So I would say really pay attention if your businesses, if you're investing in rental properties in particular, or driving rents, and then eventually rental prices do affect housing market. People buy houses because the rents go up. If rents go down, they're likely to stay where they are in a rental. So, or too many people will be. So I would say really pay attention. There's a great blog I read, Calculated Risk, is one of the best on the subject, and I'll be talking about that on my podcast this week as well. But there's amazing statistics on the rent turnaround in December and the occupancy rates dropping historically in the last couple months.
Depending on where you're in the country.
Of course, these are national statistics, but yes, for sure.
Josh, does that $1 million credit increase for Prop 19, does that increase with inflation? Will that increase with inflation?
Not the way that the law is currently written and the way it's structured.
Thank you. And I'm going to step in on this one in regard to that $1 million credit. Who determines the value of the property? I'd say go out and pay an appraiser to appraise the property for yourself. And would you like to jump in on that one for that $1 million?
Yeah. So where that appraisal is very helpful is if the assessor comes in out of whack. Generally speaking, this is generalization, the assessor actually tends to value property lower than a fair market value appraisal from the appraiser that you're talking about. We use the appraiser, the private appraisals, definitely for stepped up basis. We use them for other reasons. But when you're looking at the assessor, they tend to come in on the low side until they don't. And when they don't come in on the low side, that's when we'll use the private appraiser to say, look, you're way out of whack. Look at this data, you're using the wrong comps, or this isn't an analogous property. And sometimes we can get them to adjust that assessed value without much fanfare. Other times we actually have to file an appeal, go before the assessment board and have them, hear the evidence as it relates to the value and either get a change or don't get a change.
Thank you. Tony, can you capture that accelerated depreciation only one time or only in 1 year?
So I didn't go into too much detail about how this works, but that example that I gave about, $1.5 million property, let's say $500,000 of it is the land value, $1 million is the building. If you do the accelerated bonus depreciation, let's say 600,000 is able to accelerate, that's a one-time thing, meaning that you are taking that 481A adjustment or deduction all in 1 year. It gets added into whatever recaptured depreciation amount is on the back end if you ever sell the property, but it leaves $1 million minus the 600,000 you're taking right now, leaves you with a $400,000 basis, depreciable basis, that is then spread out over the remaining, let's say that you just bought the property, you have 27 and a half years to take that remaining $400,000 as a write-off over 27 and a half years. So to answer your question, the accelerated depreciation is a one-time thing. You are electing to take future year write-offs that you'd have to wait 27 and a half years to get. You're electing to take 600,000 of the $1 million in this example, all in 1 year, and the 400,000 remaining is left over for the remaining 27 and a half years. So yes, it is a one-time thing. But once again, you could take that property, let's say, and make, let's say you buy that property and you add a second story to it, right? So you're adding to the depreciable basis. So in this case, if you did the $600,000 this year, you have 400,000 remaining, but then in the following year, you put a $500,000 second story on the property, then you could do cost segregation election on the additional improvement and accelerate whatever the new improvement portion of the depreciation is. So there's ways to mix and match it, but in theory, if it's just the one-off scenario, yes, you only take the $600,000 in 1 year. You do not get to capitalize anymore on that unless you do an up-leg exchange and go into a higher value property with a larger depreciable basis, or major improvements are made to the property. Hopefully that made sense. Hopefully.
And if it didn't make sense, contact you.
Yeah, there you go.
Okay, I'm going to ask this one. Is it possible to exchange from a rental property into a property without a home, which I assume would be land? And if you're going from, okay, is that 1031 exchange possible? And then can you convert that new land, use that new land as a rental by putting a rental home on it? I would think so.
Yeah, so I believe that one of the major, and I'm not a 1031 exchange specialist. I know how to report it on a tax return, but I would probably refer to one of our 1031 exchange referrals or vendors for this specific question. But I believe, and don't quote me on this, but I think I know the right answer, that the land at least has to have sewage and plumbing and electrical run to it. It cannot be a vacant piece of desert land, right? Like up in 29 Palms, you can't just buy a vacant piece of land with no sewage, no electrical, nothing, and exchange into that. It has to have some sort of buildable foundation on it. And then you can build into it. In fact, I had a client who did something similar to that. It was a property that somebody had started developing, and they had laid the foundation, they had run the electrical, the sewage, but there was no drywall up. It was just literally the 2x4 standing there. And he exchanged one of his properties into that property and then took on an improvement loan. I forget what type of loan specifically it was called, but in the exchange, he took on an improvement loan and then finished building the project. And that was up in Joshua Tree, actually a beautiful, he's going to end up turning it into a retreat center of some sort, like a medical retreat center. It's going to cash flow like crazy because of that area and the rental potential in that area. But it cannot just be vacant land with no sewage, no electrical, nothing like. I believe that is the correct answer, but you probably want to talk to a 1031 exchange accommodator to just get the breakdown and detail on that.
I think they should. And if you have one in-house? Okay, because if you don't,
we do, yes.
okay, because if I can recommend someone, I wasn't sure that was the answer I would have given, so that's why I think they should check with it.
Gotcha.
Brendan, I might come back to that, but I would definitely, for your question, ask Josh that question if we don't have time to come back to it. And for Mark, talking about possible investment using your pension or 401k, you want to talk to a company that specializes in that. We have several locally. UDirect is one that comes right off the top of my head, but talk to them about doing that, about possible investment using your retirement funds into a partnership. Well, Josh, what's the typical cost of setting up a joint living trust?
It ranges probably 3,500 on the low end of 5,500 on the high end, depending on what you're doing. And then you've got some funding costs associated as well. So real property transfers, assignments of LLCs and things like that can add to that. But that's a good ballpark.
Thank you. Daniel, we've had the confirming loan limits raised to $1 million here in Southern California. Talk about the positive impact that will have on potential buyers?
Yeah, I mean, every November, December, the mortgage community waits with bated breath to see what type of increase we're going to get on the conforming loan limits by the FHFA. And, I've only been doing this 20 years. I know I started when I was 5, but I remember when I got into the business, conforming loan limit was like 350,000. I can't believe that we're now, over $1 million. You can borrow $1,089,000 on a conventional agency Fannie Freddie loan in a high cost area, which luckily LA County is considered a high cost area. San Bernardino, Riverside, and other surrounding areas have lower limits for the most part, but they even saw an increase. You can buy something out in those counties up to $726,000 on the loan amount. So if you do some reverse engineering, you can essentially buy a home for about 1.15 purchase price, 1.15 purchase price, put about $60,000 down, which is 5% of the purchase price, and get an unbelievable loan. Good rate. PMI is such a negligible factor now with the PMI companies essentially going to PMI war. Such a small factor now. It used to be hundreds of dollars a month. PMI, I've seen it as low as $35 a month. And so, I think that it's really lowered the barrier to entry for a lot of folks. And you can get a really, really great loan, a really great conventional loan, up to $1,089,000 in high cost areas.
Thank you very much.
Hey, Bill, really quick, I just messaged our accommodator and he said that it is possible to go into undeveloped land. However, the one thing that I probably was trying to get to is that if you plan to buy a vacant lot and develop it, you cannot benefit from its sale after the exchange, because then it becomes an ineligible exchange. So you can go into vacant land. It's just you can't on the back end then sell it and benefit from it. So there's a stipulation on the back end. But if you exchange into vacant land and develop it, you just can't.
Developers can't go from an industrial building to vacant land to develop into another industrial building and sell that and benefit from the sale of the building?
Correct. Personally benefit from it. Correct.
Personally benefit, okay. Just I
Yeah.
thought you could do it, but I didn't know that last part.
Yeah.
Okay. So if they kept the land and sold the land at profit, they could take that profit to the 1031, that next profit into the next one.
Correct. Correct.
Karen Patterson has a question about reasonable rent increases. Isn't that and I'm not sure where her property is located, if it's in California, isn't it 10% right now? Rent increase maximum limit? Can somebody on the panel address that one? Rent increases in the state? Don't we have a state? Rent control? Okay, I guess we don't.
Yeah, I mean, there's state, there's county, there's city.
There is a state rent control ordinance, right, that applies just generally across the state, unless the city or jurisdiction you're in has a more restrictive, overlay. It's all based on a CPI plus a percentage. So every jurisdiction does it slightly differently, what they allow and what they don't allow, but it's highly localized. But there is a general, California rent control. Yeah.
Got a couple more minutes. Tony, if they take that bonus depreciation and let's say it was 600,000, they will lose the property in foreclosure. What is the impact of the $600,000 depreciation that's already been taken?
We saw a lot of this back in 2007, 8, 9, well, not 2007, but mostly 2008, 9, and 10, where when properties go into foreclosure, remember that your initial purchase price, let's say at a million, we'll use this example that I gave earlier, $1.5 million purchase. Let's say it goes into foreclosure and it ends up selling. I'm just throwing numbers out there. Let's say it ends up selling for $700,000, right? So you lost $800,000 hypothetically on the deal. If you had $600,000 of recaptured depreciation, you would have to include that as income on the property. But when you lose $800,000 on a rental property, it's called a 4797 business loss. And that loss overall should offset any recaptured depreciation upon sale or foreclosure. So there's going to be some sort of reporting requirement. I'm not going to say it's always going to map out in your favor because foreclosures are really, really tricky because unlike a short sale where you actually have a 1099-S, it actually has a sale price. Of foreclosure, what we saw during the last recession is that foreclosures could have stayed on the market for a year or 2 years. And so clients were getting these 1099s a year and a half, 2 years later from these foreclosures from the banks. And now they're having to report it based on that sale price because that's what the bank eventually sold the property for. And then they kick out this 1099. The banks eventually stopped sending out the 1099s because in 2007, they had the Debt Exclusion Act of 2007 saying that if you individually were insolvent or your debts heavily outweighed your actual assets or equity, financially speaking, that you wouldn't have to actually pay the cancellation of debt tax on it. So there were some changes in 2007, 2010. So for 3 years, California would hit you with income tax on it. And then in 2010, the Conformity Act kicked in, which basically hopped on board with the federal government, allowing you to walk away from properties that were underwater, free from having to pay tax on the cancellation of debt. But with rental properties, it was different. Rental properties had depreciation recapture as well. So even though you lost on the property, if the depreciation recapture was greater than the loss that you took on the property, then yes, there would be a tax implication on whatever that difference is. Like I said, we saw a lot of that during the last recession. I haven't filed an insolvency filing in probably, no joke, over 10 years. I haven't seen foreclosures and short sales at all since 2000. I say the last time I saw one was maybe 2011. So I feel very fortunate to not have clientele who are in those kind of dire straits. But at the end of the day, yes, the recaptured depreciation would still have to be recaptured. The only time that depreciation can actually be reset and wiped out is upon death. It's when you pass away and you leave your heirs these capital assets, they receive a full stepped up basis. And that wipes out depreciation and any capital gain tax because the property is left for you in death and it's not being sold while your loved one was still alive. So that was probably a little bit more than what you were asking, but yes, there might be a tax implication on the recaptured depreciation. We have to map out those numbers for you though.
The clock has struck noon and time is up. I would like to thank my panel. And I don't know about the feeling of our audience, but there was a tremendous amount of information disseminated today. And I wish to thank all of you for that. Do any of you have any last thoughts or you'd like to share with us?
I can
Go,
go first. I can
Go.
go first. It's all about building the right team. We at Robert Hall and Associates, we've been around since 1971. We have obviously used a lot of vendors over the 50 plus years of being in business. I've been here for over a decade and a half. And all of the individuals on the call today, I've personally spoken with. We do a really good job, and I'm truly believe this. We do a great job vetting out our referrals and the people who we bring on to service our clients' needs. And this is the team that we've built. So just like we've built our team, I would suggest that you surround yourself with a team that's going to be able to support all of your financial needs and who can answer questions and be available to help you structure things in certain ways. I know I've sent clients over to Josh, and Josh has assisted many times with questions that were way out of my lane of expertise, and so I appreciate that. Daniel has done a ton of financing for our clients and will continue to be the go-to professional financer for all of our clients, go-to referral. And Bill Gross, we've talked many times. He's got a wonderful podcast. He's got great information. These are the kind of people that you have to surround yourself with. So if you are a veteran investor, you probably already have a team. But there's always chances that your team might end up retiring or moving, or might not be keeping up to date with a lot of the new codes. And so you might want to onboard in future years. We're here and readily available to assist. But that's really important in business. Whether you're a new investor or a veteran investor, it's all about building a team around you. That's all I have to say, though.
Before I continue, yes, there's a recording that will be available. You have to request it, and so reply to the event email invitation after this event is concluded, and they'll be happy to send you a link to the recording. So yes, there's a recording available. This will not go to waste. This is a lot of great information. So Josh, your final thoughts, please.
I would just echo what Tony said. And you'd be surprised. I have some clients that have excess of $100 million in real estate, and they have no team, and they're doing their own return on TurboTax, and probably missing lots of deductions. I didn't go that deep. We focused on the estate planning side, but yeah, probably is right. It can't really be understated enough, overstated enough. There's so much to this. I mean, we just scratched the surface on each of the topics that we talked about. Google is great, but it's not a replacement for your individual factual situation. And you really need, that's where the professionals come in, is taking those facts that you can probably find independently and applying to your situation and what actually works for you. So definitely take advantage of that. Take advantage of each of us here and ask your questions and see how we can help.
And let me add that I'm sure most of you have a small free consultation that people can get. That said, please don't be afraid to pay for good advice.
Yeah, and for me, right, we do that. We do a consultation at no cost, and that's really to make sure there's a fit and that I can help you. Once we decide that, okay, yeah, there's something here and I can do something, then we'll quote you a fee and go from there. And I'm sure Bill and Daniel are probably the same way.
There's a saying that, you get what you pay for when it's free. A good professional will not only save you money, but in most cases make you money. Daniel.
Yeah, just grateful to be a part of this group and this syndication of really smart people. Wishing everybody a strong, healthy, successful 2023. There's tons of opportunity out there, and hopefully we brought some of that to the surface for everyone today.
Okay. And Bill.
Well, I really appreciate, meeting Josh and Daniel. I work with lenders and attorneys every day. These guys are definitely really sharp. I appreciate their input and hope you get a chance to work with them. I'd say the same about Tony, but I'm already a client at Robert Hall. So I have been for a couple of years. And I will say, as a result of one of these presentations a couple of years ago, I had been doing my own taxes and charting my own course, and he really challenged me, I think, to up my game. And while I've paid fees to the company over the years, I've saved tens of thousands of dollars as a result of the proper strategies for my business. So I would definitely urge you to reach out and get a proper plan in place and execute the plan. So, and to everybody, thank you for letting me participate today.
And I'm going to ask, thank you very much. For a link to the recording, if you're just listening to this, please email Ronnie, R-O-N-Y, at roberthalltaxes.com. That's Ronnie, R-O-N-Y, at roberthalltaxes.com. And I'm Bill Tan. I wish to thank all of you for being here. I wish to thank my guests. I got to meet some new people. I barely get to see Tony, who I really enjoy always talking with. And I met Bill Gross a month ago and enjoyed speaking with him tremendously. And I got to meet two new friends, Josh and Daniel. And I hope to talk to you guys some more in the future. We hope to see you again next year, same time, same place. If not sometime in this upcoming year. Please remember, grow a team. You have these people here to take advantage of for your team. And thank you. Goodbye now. And we all wish the best of you for a very profitable and happy and prosperous 2023. Thank you for coming.
Thank you.
Thanks, everyone.